let's take a look at Mackie PLC. For the 9 months ending December 2025, their revenue actually dropped by 3%. But their cash position shot up by over ₹1 billion. So how on earth does that happen? We're going to find out.
Right. So on the surface, you see sales dipping. But what's really going on underneath is this incredible 1.26 billion rupee swing in cash. The whole story, the real answer, is buried in their financial statements.
Okay, just a quick disclaimer before we dive in. This presentation is just my personal take, for informational purposes only. It's definitely not financial advice. Also, you'll see some figures marked as adjusted data, which might be different from the official numbers. And for the record, I have no financial interest in Mackie PLC.
All right, so first up, sales are down, but profits are up. How does that work? Let's unpack this paradox, and the first place to look is the P&L statement. So check this out. Revenue, it's down 3%, but look at the gross profit. It jumped by over 13%. And the only way that happens is if your cost of sales drops even faster than your revenue, which is exactly what happened here. They fell by over 5%. This tells me one of two things is going on. Either they've found a huge efficiency, or they're consciously selling more high-margin stuff.
And that improvement in their margins? Well, it pushed their operating profit up by almost 14% to 687 million rupees. That's a solid number. But look at these finance costs. They're heavy, over 320 million rupees. That basically ate up almost half of their hard-earned profit, really putting a damper on the final bottom line.
Okay, so the improved profit is interesting, but it's really just one piece of the puzzle. It doesn't explain that massive cash turnaround we talked about. For that, we've got to look at the balance sheet. This is where you can see the strategy they've been playing out.
First thing they did, they cut their inventory by 11%. Now, what does that really mean? It means they turned 415 million rupees worth of boxes sitting in a warehouse into actual cash in the bank. This isn't a fire sale. This is a smart, deliberate move to free up capital.
The second big move they made was restructuring their debt. And this is a classic playbook move for de-risking a company. You're essentially just changing the type of debt you have on your books to make your finances way more stable for the future.
And the numbers here are just, wow, they show a really clear pivot. Look, they slashed their short-term borrowings, which is the risky, high-pressure stuff, from almost $4 billion down to 2.6 billion rupees. At the same time, their long-term debt jumped up. Think of it like this. They basically paid off a high-interest credit card by taking out a stable, fixed-rate mortgage. It's just smart, defensive financial management. So to recap, they've unlocked cash from inventory, and they've stabilized their debt. Great, but did it actually work? To see the payoff, we have to go to the cash flow statement. You know, this is the ultimate scorecard. This is where the truth comes out. And boom, there it is. The answer to the question we started with. Their operating cash flow went from being negative 700 million to a positive 540 million surplus. That's the 1.26 billion rupee turnaround right there. And you can see it was mostly driven by selling off that extra inventory. But just getting cash isn't enough. We need to know, how good is this cash flow compared to the profit they claimed? Well, analysts have a tool for this. It's called the cash conversion ratio, or CCR, and it's basically a reality check. It asks a simple question. For every 1 rupee of profit you say you made, how much actual cash did you put in the bank?
Mackie's ratio was 1.97. Let me be clear, that is exceptional. It means for every single rupee of profit they put on their income statement, they generated almost 2 rupees of cold, hard cash. You just don't see that very often. This is the definition of high-quality earnings. But look, a good analysis isn't just about cheering for the good news. We have to be objective. While the company was doing all this great work to strengthen its finances, there was one number that was, well, it was moving in the wrong direction, and it raises a red flag we have to talk about.
And here it is. This is the problem. Remember, revenue went down by 3%, but receivables, which is just the money that customers owe them, actually went up. You see the issue? Those two things should really be moving in the same direction.
So what's the risk here? Well, it's a couple of things. One, it could mean their customers are having trouble paying their bills on time. Or two, it could mean the company is having to offer super generous payment terms just to close a sale, and that's not a tactic you can sustain forever. Either way, it's a definite red flag that needs to be monitored very closely in their next report.
So, after all that, what are the big takeaways? If we pull this whole thing together, this case study on Mackie actually gives us 3 really important lessons for anyone who wants to look past the surface-level headlines.
Okay, lesson 1.
Cash is absolutely king. A high cash conversion ratio, like that 1.97, tells you the real quality of a company's earnings in a way that profit just can't. Lesson 2. Debt isn't just a number, it's about the structure. Swapping short-term for long-term debt is a really smart de-risking move. And finally, lesson 3. Always watch for those divergences. When you see something like sales going down while receivables go up, that's your cue to start asking more questions. By the way, if you find this kind of breakdown useful, make sure you're subscribed to the channel so you don't miss the next one.
And that leaves us with one final question to think about. The income statement told one story, a company with sales that were slipping a little. But the cash flow statement told a completely different story, a company generating a huge amount of cash. So, when a company's financials are telling you a story, which narrator are you going to trust more? Profit or cash?